Hello everybody, my name is Sapna Ravishka and today I'll discuss with y'all the cash flow statement which is based on IAS number 7 or LKAS number 7. So to begin with the discussion, first let's identify the need for a statement of cash flows. So as we all know, profits is not the same as cash flows because statement of profit or loss we prepare based on the accruals concept and statement of cash flows we prepare based on the cash basis. So the major issue in the statement of profit or loss is that it shows some imaginary figure on the statement prepared based on the accrual basis. It does not show the real amount of cash which the business has to fund their working capital requirements. So, if we take decisions solely based on the amounts mentioned in the statement of profit or loss, then we are neglecting the going concern concept because in order to measure the going concern concept, we must assess whether the business have sufficient amount of cash to fund their working capital requirements. So the last point clearly says the purpose behind preparing a statement of cash flows. Therefore, it is important that the users of the financial statements can assess the cash position of a business at the end of the year, but also how cash has been used and generated by the business during the accounting period. So the basic reason why we are preparing a statement of cash flows is that to facilitate the users to assess the cash position at the same time to show them how cash has been generated and used within the entity during the given accounting period. So when looking at the objectives of LKS number 7, report the cash generation and cash absorption for a period by highlighting the significant components of cash flow in a way that facilitates comparison of the cash flow performance of different businesses. And also to provide information that assists in the assessment of their liquidity, solvency, and financial adaptability. So these objectives and definitions are directly extracted from the standards. So you'll have to keep them in your mind, especially when answering the MCQs. And next, let's look at the format of the statement of cash flows. So we prepare a statement of cash flows for the year ended. And a cash flow statement will include three basic headings: cash flows from operating activity, cash flows from investing activity, and cash flows from financing activity. So each of these headings will be explained in the following slides. So the definitions given for each of these activities will help you when categorizing a particular cash flow as operating or investing or financing. So the net figure under each of these headings, we usually write them as net cash flow from operating activity, net cash flow from investing activity, likewise. But also you can write them as, if it is a positive net figure, then you can use the wording as net cash generated from operating activity. If it is a minus figure, you can put it as net cash outflow from operating activity, likewise. And the last three lines are really important because the third line, the net increase or decrease in cash and cash equivalent shows the net figure of these three activities. And cash and cash equivalents at the beginning of the period and cash and cash equivalents at the end of the period. So I'll explain to you all what this cash and cash equivalent is in the next slide. Okay. So cash and cash equivalents. So I've given the definitions for the cash and cash equivalents under the first point. It comprised of cash on hand and demand deposits together with short-term, highly liquid investments that are readily convertible to known amounts of cash and that are subject to an insignificant risk of change in value. So these wordings are really important. You know what is meant by cash on hand, the amount of balance that we have in our locker to fund the basic requirements of the business, day-to-day requirements, working capital requirements. And demand deposits, you know the type of deposits where you can handle the transactions through checks, you can do payments through checks, deposits, etc. together with short-term, highly liquid investments that are readily convertible to known amounts of cash. This means the short-term investments like treasury bills, etc. So the maturity should be less than 3 months in order for it to be short-term. And the equity investments are normally excluded because we all know that when we say equity investments, those are generally long-term, unless they are in substance a cash equivalent. So if the question specifically mentioned that they are in a substance of a cash equivalent, you can include it under cash and cash equivalent amount. And also bank overdrafts, which are payable on demand and which form an integral part of the entity's cash management, are also included. So the decision to whether to include a particular figure as a cash and cash equivalent or not will solely depend on the details given in the question. Okay, so you'll have to read the question properly to understand what comes on the cash and cash equivalents and what not. So cash generated from operations. The main revenue producing activities of the entity that are not investing or financing activities. So that's the definition for operating activities. The main revenue producing activity, which is the sales of a business. If it's a manufacturing organization, then selling their products. If it's a service providing organization, then providing their services. So which are not coming under investing or financing activities. So when you're identifying a particular cash flow under operating activity, you need to make sure that it does not come under investing or financing activity. So whatever the cash flow which is related with the main revenue producing activity, which is sales, you can include it under cash flow from operations. So there are two basic methods of presenting the cash flows from operations. One is direct method and the other one is indirect method. So most of the time people refer this as two methods of preparing the cash flow, but rather these are two methods of presenting the operations activity, the cash flow generated from operating activity. Those are not two separate methods of preparing a cash flow statement. So let's first focus on the direct method. So this shows each major class of gross cash receipts and gross cash payments. So this method is pretty much straightforward because you just have to directly take the cash paid or received amount into the statement of cash flows. So in this format, this is not a standard format again, this is just an example. So in this, I have mentioned some cash inflows and cash outflows under the direct method of representing the operating cash flows. So cash receipts from customers, cash paid to suppliers, employees, etc. Interest paid and income taxes paid, etc. And this is the indirect method. So indirect methods is the only hardest part in this cash flow statements, I would say, because it is the only tricky part where you have to deal with some of the adjustments. So this adjusts accrual basis net profit or loss for the effects of non-cash transactions. So what we do under the indirect method is so what we do under the indirect method is we directly extract the profit before interest and tax amount, which is the operating profit amount, directly from the statement of profit and loss, and we convert that profit figure which is prepared based on the accrual concept. We convert that figure into a cash figure based on the cash flow. So whatever the adjustments which have been made under the accrual concept will have to be reversed. So some accrual adjustments like depreciation, impairment of assets, loss or gain on disposal, and interest payable, etc. So this loss or gain on the disposal of assets is actually not an adjustment made based on the accrual concept, but we are reversing this because it's not a cash flow. It's not a cash inflow or cash outflow. So this profit figure we have included in the statement of profit or loss, the operating profit figure. So whatever the non-cash inflows and outflows, we have to adjust it under this heading. And so if I'm to explain you all about these adjustments, so depreciation we have already deducted from the profit figure, from the operating figure. Sorry. So depreciation we have already deducted from the profit, so we have to add it back to cancel that adjustment. And add back impairment of assets. Impairment of assets, impairment is for intangible assets. Whatever the amount which was deducted from the profit, you have to add it back to cancel the adjustment. And loss or gain on disposal. For example, if we take it as a loss, then we have already deducted it from the profit, but it is not actually a cash outflow. So we have to add it back when converting the profit before interest and tax into a cash figure. And on the other hand, if it is a gain on the disposal, we have already added it to the profit figure. So then we are, when reversing, we have to deduct it from this profit before interest and tax under the statement of cash flows. And also interest payable is an adjustment based on the accrual concept. So we have to reverse it back. And this working capital changes is a separate heading. So under this, we include the current assets and current liabilities, excluding interest received, interest paid, dividends received, and taxes. Interest received and paid, dividend received, and taxes. Excluding those current assets and current liabilities, the other current assets and liabilities, for example, like trade receivables, trade payables, and inventories, any increase or decrease in such figures, we take it under the working capital changes. So any increase in a current asset, we deduct it in the statement of cash flows. Any increase in a current liability, we add it back. We add it under the statement of cash flows. So for example, if I take increase in inventory, so if the opening inventory is less than the closing inventory, which means the inventory amount has been increased during the period, then we deduct it from the statement of profit or loss. So if the opening trade receivables is less than the closing trade receivables, which means that the trade receivables has been increased during the period, so we have to deduct it from the statement of profit or loss. So likewise, if there's a current asset increase, we deduct it. If there's a current asset decrease, we add it. The opposite of the increase or decrease. But when it comes to the current liabilities, we do the opposite of what we did for current assets. So for example, if I take the opening trade payable amount is less than the closing trade payable amount, which means the trade payables has been increased during the period. So that we simply add it in the statement of cash flows under the working capital changes heading. So any increase in the current liability during the period, we add it. Any decrease in the current liability during the period, we deduct it. That's how you adjust the working capital changes. And for these working capital changes, we never take the interest payable and receivable, the dividends receivable, and taxes. Those three headings are excluded under this working capital changes. So this interest paid and tax paid, we show them as two separate lines because those are two material elements. So after that, we get the net cash from operating activity. And then let's focus about the cash generated from investing activity. So these are the acquisition and disposal of long-term assets and other investments that are not considered to be cash and cash equivalent. So under the cash and cash equivalents definition, I've explained clearly that we take only short-term investments into consideration. So the long-term investments come under this investing activity. The equity instruments, the treasury bonds, etc., shares. So for cash inflows, we can give examples like interest received, dividend receipts, proceeds of sale of non-current assets. Then for cash outflows, we can say purchase of property, plant and equipment, investing in financial assets, etc. And also the cash generated from financing activity. The activities that alter the equity capital and borrowing structure of the entity. So this is the definition for financing activity. Any activity which alters the equity capital or borrowing structure of the entity. So here we have to clearly distinguish among two concepts. If we are investing in shares or any equity instrument of another company, then you put it under investing activity. Any investments made on other companies' equity instrument or shares or whatever you call it, that comes under investing activity. Any income received from such activities are also coming under investing activity. But whenever you issue shares, you issue your own company's equity instruments, then that comes under financing activity because it changes your company's equity capital and borrowing structure. So that that part have to be distinguished properly to include it under the relevant heading. And if I am to give some examples under cash inflows, financing activity, proceeds of sale of, proceeds of issue of shares, proceeds of receipts of loans or debentures, likewise. Cash outflows, repayment of loans and debentures, dividend paid, interest paid, etc. Yeah, and these three are special points that I want you all to focus on because these can be tested under MCQs especially. Interest and dividends received and paid can be classified as operating, investing, and financing cash flows, provided that they are classified consistently from period to period. So this interest and dividends paid and received, you can classify it under any of these three headings, as long as it's not specifically mentioned that it comes under operating or investing or financing, likewise. So generally, you can classify these two elements under any of the three headings. But you have to consistently carry that practice from one period to one period. Consistency concept, basically. And cash flows arising from taxes on income are normally classified as operating, unless they can be specifically identified with financing or investing activity. So we normally know that taxes, the income taxes that we pay from the entity, are usually associated with the major operating activity of the business, major income generating activity of the business, which is sales. So that's why we are including it under the operating activity. But if the question have specifically mentioned you that the taxes are related with investing or financing activity, then you have to clearly mention it under the relevant head. And for operating cash flows, direct method is encouraged, but the indirect method is also acceptable.